Hi, Gabriel Josiah here. In this session, we are diving deep into the interest coverage ratio, a powerful tool that not only highlights a company's ability to pay its debt, but also helps you make smarter decisions. Whether you are in an exam hall or the boardroom, this ratio and understanding it comprehensively is key. Let's break it down into bit-sized insights you can use in real life. Let me share my screen quickly. It's our custom as we look graphically into this ratio. Okay, I've gone minimum, like I humorously say, always. And let's describe the interest coverage ratio. This metric measures a company's ability to pay interest on its outstanding debt. So every debt the company procures or incurs in terms of bonds, bank loans, preference dividend have fixed interest, and the ability to pay is key for a company. And that payment comes on the profit before tax. So the profitability of the company is essential. So the profit before interest and tax is the element used here of interests and not the principal. It indicates how easily a company can meet its interest obligations from operating income. Operating income before any deduction of interest and taxes is used to calculate this ratio. The higher ratio indicates a greater ability to cover interest expenses, suggesting a lower risk of default. So how many times the income or profit covers the interest expense signifies a greater ability and lower risk of default. So the formula is on the screen. The interest coverage ratio is the earnings before interest and tax, or profit before interest tax, divided by the interest element or the finance cost of that loan. Earnings before interest tax represents the company's operating income, while the interest expenses are the costs incurred by the company for borrowed funds. Okay, so let's buttress this graphically with the example we've been using to calculate these ratios. So let's look extensively at the earnings before interest and taxes. So from the SCI or the income statement, we have gross profit, we have the profit before depreciation and amortization, we have the profit before finance cost. So we take the profit before depreciation and amortization, which depicts practically the earnings before interest. So we take for 2020, which is 120 million. So let's take this amount and calculate it. If you have your calculator with you, or using Excel, just follow me closely. It's 120 million. So I'll call it profit before depreciation and amortization. Call it earnings before interest, taxes. Okay, so that is 120 million. And I would also take the interest element. So the interest expense is the finance cost, which is the interest on the loan, and it includes 20 million. So I'll pick that. It's the interest expense for the calculation of the interest coverage ratio. So let me remove the negativity here, and our interest coverage ratio, or interest cover, could call it, is our earnings before interest and taxes divided by our interest on the loan or finance cost, which is 6 times. So our earnings covers our finance cost 6 times. So the risk of default is minimal. It's very low in this regard. So it means earnings or operating income is able to cover our finance cost 6 times. So let's look at what that means. What does it mean? It reflects the number of times a company can pay its interest expense with its earnings its organic earnings. A high ratio indicates a strong ability, like we've seen 6 times, a strong ability to cover interest payments, while a low one, maybe 2, 1, less than 1, shows potential difficulties in meeting these obligations. The implication is that a higher interest cover, generally seen as favorable, indicates that a company can comfortably meet its interest payments, which is reassuring to creditors, loan providers, and investors. Conversely, a low ratio may raise concerns about a company's financial stability, potentially leading to higher borrowing costs or difficulty in securing new loan financing. And the cause and effect is for a higher interest cover, strong operational performance shows that the earnings or the operating income is high, it's good, it covers the interest element. Efficient management of expenses and low levels of debt is the cause of a high interest coverage ratio. While the effect is greater financial stability, improved credit ratings, and easier access to capital. So this is encouraged for all businesses to have a higher interest cover. While a low interest cover, which is discouraging and is not advisable for any business, the causes are weak earnings performance, high levels of debt, or significant interest obligation relative to income. So interest obligations are higher in relation to the earnings. Where you have less than 1 or 1, it's a bleak situation. While effects is increased risk of defaults, where you have a low interest cover, potential cash flow issues, and challenges in obtaining additional financing. This is risky for the business. So providers of capital will not want to give, especially external providers of funds, to a company with a low interest coverage ratio. All right, in conclusion, the interest coverage ratio is a critical indicator of a company's financial health and ability to meet interest obligations. By evaluating the relationship between operating income in terms of earnings before interest and taxes and the interest expenses, stakeholders, the providers of capital can assess the risk associated with the company's debt levels. So this is key. Maintaining a healthy interest coverage ratio is essential for ensuring long-term financial stability and fostering confidence among the investors, external providers of capital, even shareholders or the ordinary shareholders, common stockholders, and creditors is key. So this ratio, to some extent, for some companies, also some providers of capital, is a prerequisite for them to provide debt or loan to that company. They ask you for your financial statements, and this ratio specifically should be calculated to see if their debt can be paid back, the interest and the capital. It's important that accountants to be able to strike a high operating income to cover interest expenses, to be able to expand and grow the business in terms of borrowings and funds. Don't forget, balance is key also between equity and debt. Striking that balance is a key skill for a chartered accountant or accountant in training, and this is very, very important. All right, having looked at the interest coverage ratio, which is your ultimate guide to mastering this key financial metric. Remember, whether you're preparing for exams or analyzing real-world financial statements, this ratio is your best ally in assessing debt sustainability and financial health. Don't forget to like, share, and subscribe for more practical accounting insights tailored for you. See you in the next video. And until then, bye for now.